Okay, chapter 8 is about accounting and decision making by the numbers. So here are your learning objectives. I encourage you to look for answers to these learning objectives as I move through the lecture. So, accounting, who needs it and who does it? Well, first of all, my degrees are in accounting, and so this is probably one of my favorite chapters. Accounting is the language of business, and it's a system that is used to take information, financial transactions, and organize it and provide users with relevant, timely information. And users need this information to make better economic decisions. Who uses accounting? Managers need up to date facts about sales, debt, cash, inventory, and capital. Stockholders use accounting to learn about the financial performance of their company. Creditors use accounting to access borrowers' creditworthiness. Suppliers use accounting to confirm whether a company can pay them back. Government agencies like the IRS and the SEC use accounting for their reporting purposes. And then others are news media, competitors, and unions. We have public accountants. They prepare tax reports, undertake external audits, and give advice to companies. Then we have management accountants. They assist managers, analyze, and prepare reports and financial statements. Government accountants perform different accounting functions for the local, state, and federal government. Accountants need expertise in complex subjects. That's why many of them take up certified courses. CPAs, certified public accountants, are certified to audit the accounting records of public and private organizations. And they attest to the compliance with GAAP, which stands for Generally Accepted Accounting Principles. And CPA offices, they provide many accounting services. And I'm not going to cover all of them, but I will say that CPAs and the CPA offices provide advice on any matters related to accounting. They help develop budgets, prepare financial statements. Those are just some of the few. So here, this says do an online search, and you can investigate what exactly is involved in becoming a certified public accountant. And a good place to start, well, you could just look up certified public accountant. In section 2, we're going to talk about financial accounting. Financial accounting involves preparing financial statements. These financial statements help stakeholders understand their firm's performance through the year and compare the firm's performance with that of its competitors. And stakeholders are going to look at this, investors. And here are the major outputs down here. If you take accounting or have taken accounting or currently taking accounting, you know that about the financial statements. These are not in order, but the income statement, then the statement of owner's equity, and then the balance sheet. And you also have the cash flow statement. Here is GAAP, generally accepted accounting principles. They aim at reducing confusion and they provide all stakeholders with consistent and accurate financial statements. And then you have FASB. So in the United States, the ultimate legal authority to set and enforce accounting standards is the SEC, but the SEC has delegated the task to FASB, which is the Financial Accounting Standards Board, and FASB follows GAAP. So GAAP is, like I said, I like to call it the rules. And FASB is the governing body. And through GAAP, by following those rules that are GAAP, FASB oversees that and ensures that financial statements are relevant, reliable, consistent, comparable. Financial statements should contain information that's going to help users understand the firm's financial performance and condition. So that would be relevant. And the financial statements should supply objective, accurate, and verifiable information. So that would be reliable. And then a financial statement should be based on the same core assumptions and procedures through time. That means consistent. And then a financial statement should be presented in a standard way that allows users to compare the financial performance of the firm through the time. So that would be comparable.
Unfortunately, there are examples of where accounting fraud, include incidents where debts were hidden or earnings were wildly overstated. And these scandals have prompted the accounting profession toward major improvement in ethical training and standards. Let's talk about the financial statements. There are 3 basic financial statements, and I will change that to say really there are 4. You have your income statement, you have your statement of owner's equity or statement of stockholders' equity, your income statement and, we're going in order, your balance sheet and your statement of cash flows.
And large corporations that publicly trade their stocks have to publish an annual report with these financial statements, and the one that was left out was the statement of stockholders' equity or statement of owner's equity. And these corporations also have to file their quarterly and annual reports with the SEC. So the balance sheet, it's going to report, I hate that they went out of order here. I'm going to start with the income statement. So the income statement is going to report the revenues and expenses, and it's going to give you the net income. And we talk about in accounting the accrual basis of accounting. So the accrual basis, you have to use this in order to follow generally accepted accounting principles. So the accrual basis says recognize revenue when it's earned, regardless of when you receive cash. You record revenue when it's earned. So that could be providing a service or selling a product. And you're going to match the expenses in the same period that the revenue is earned. So this is the first financial statement that is prepared. So here you see sales revenue and minus your expenses. Now this income statement, it would be, they're providing a product here. And then you have your expenses, and then you have taxable income. But basically what I want you to know is revenue minus expenses gives you your net income. So you have your income statement, then the net income would go on the statement of owner's equity. And if you have income, it would increase the owner's equity. If you had loss, it would decrease the owner's equity. So you would prepare the statement of owner's equity next. And then after the statement of owner's equity, you have the balance sheet. And the balance sheet basically is the accounting equation. Assets equal liability plus owner's equity. So assets are things in the business that you own. Liabilities are things that you owe. And if you take what you own and subtract out what you owe, that is what's left over is the owner's equity. So it's the claim of the firm's owners, what they can claim of the assets that are left. So here is what a balance sheet looks like. You have your assets, you have current assets and long-term property, plant, and equipment. And then you have your liabilities plus your owner's equity. So your total assets should equal your total liabilities plus your equity. And all of this can be seen in your text. All right, and then the statement of cash flows. And when we teach accounting, usually the statement of cash flows is going to be in accounting 2. So we really don't talk much about this in accounting 1. But you have your cash broken down into cash from operating. And this is going to be cash from the sale of goods or services, or cash from dividends and interest earned. Then you have your cash flow from investing. And this is any cash that you receive from the sale of your fixed assets. Some examples would be land, buildings, equipment. And then you have your cash flows from financing. And this is cash that you receive from financing activities like issuing shares of stock or taking out a loan from the bank. Those are just some examples, and this is what the cash flow statement looks like. And it does mention the owners, the statement, and it is one of the main financial statements. So there are 4 main financial statements. So on the stockholders' equity, it's going to show changes in equity. So if it's stockholders, there's going to be anything that arises from issuing stock would go here. But notice that net income is going to be on this statement. A lot of times it shows, it's called a statement of retained earnings. But if it's a corporation that issues stock, it's called the stockholders' equity statement. Okay, read this question and pause the video and read it. And then when you're ready to hear the answer, press play. The correct answer is D. The